Huge surge for the Dow, S&P, and the NASDAQ today. Welcome to Bloomberg Technology. I'm Emily Chang, sheltering in place in San Francisco. And today, Facebook, Tesla, and Microsoft all skyrocketing after hours as they all report better than expected earning results. Facebook saying they did see a significant decline in ads in the last 3 weeks of the quarter, but in the first 3 weeks of April, already starting to see some signs of stabilization. Also, Facebook blowing past expectations for users and ad revenue. Meantime, a drug from Gilead Sciences also showing some positive results that may have been giving investors some optimism earlier today. We're going to get to Facebook, Tesla, and Microsoft in a moment, but I want to bring in our Bloomberg Markets reporter, Taylor Riggs, first to wrap up the day that was. Taylor, huge optimism here. That said, we also got some data showing that GDP fell 5%. What's going on here?
I think that you sort of hit it on the head there when you said that people were already looking through the data in Facebook, for example, and thinking that maybe things aren't as bad as we think and that there is a sign that things could already start to stabilize, if not improve. You could arguably say that that was going on in the markets all day long. We got that data of a 4.8% drop in GDP earlier this morning. Markets were already shrugging it off, looking ahead to that news that we got from Gilead, I should see. I do want to notice here that tech, of course, is doing the best. It's up 3.6% today. And Russell, those small cap stocks, also some of the biggest outperformers as we continue to talk about how to reopen the economy. Gilead Sciences was the driver behind all of this as they were up more than 5.5%. They said that because of results of a U.S. government-run study, it showed that their experimental drug, remdesivir, helped coronavirus patients recover more quickly, some perhaps 11 days instead of 14 or 15 days that was initially expected. And so Dr. Fauci then came out again and said that this was a very, very positive sign. So perhaps all of this is looking past some of the negative data we got this morning and looking forward to future optimism.
Meantime, Taylor, Tesla and Microsoft shares skyrocketing, Facebook even higher. Let's start with Tesla and Microsoft. Tesla beating on revenue expectations, still saying they have the capacity to deliver 500,000 cars before the end of the year. And Microsoft obviously driven by a lot of this remote work that's happening from home. Wrap up the numbers for us.
Yeah, huge numbers out of both companies. Tesla beat on both revenue and adjusted earnings per share, getting a big boost on the bottom line despite a loss year over year. Free cash flow, though, Emily, if there's anything to caveat this, free cash flow is negative $900 million. That's worse than the expected drawdown in cash of about $600 million. The first quarter, they said, was impacted by deliveries. Remember, they had a goal of 500,000 deliveries in 2020. They are going to revisit that 2020 guidance in the second quarter, so we won't get details from them further on about the year until about June or July or so. Microsoft, similar story. Big numbers on the top line, 15% gain year over year. The cloud is better, and we saw this with Google and Alphabet yesterday. Cloud growth was a bright spot for the company. That is similar with Microsoft as well. They said cloud usage increased in a lot of their segments. And then, of course, personal computing. We're all staying home and working from home. That benefited as well.
Now, to a certain extent, we expected good news from Microsoft, to a lesser extent, Tesla. Facebook is really the surprise here. 2.6 billion monthly active user now, also beating on daily active users, and a significant increase in ad revenue despite that slowdown towards the end of the quarter. What's your take here?
My thoughts are we learned this from Google yesterday. They said that things were bad. The advertising market was weak, but it wasn't as weak as we thought. Estimates coming in from analysts yesterday as it related to Alphabet were much worse than expected. You're seeing a similar theme come here across with Facebook as well, where they said revenue was flat in the first 3 weeks of April year over year, but it wasn't negative, and they are already showing signs of stability within that advertising market within those first few weeks of April. And April really is supposed to be the worst. So if you're seeing revenue come in flat on a year over year basis in the worst of all of this, that is a big outperformer relative to expectations when we thought that ad revenue would decline significantly. So it's showing that these big advertising companies are proving to handle this better than we thought.
All right, Taylor, thanks so much for that update. We're going to continue to monitor these headlines as they roll in and the earnings calls begin. Taylor, thanks so much. I do want to bring in Deborah Aho Williamson now of eMarketer, who covers Facebook. Deborah, I'd love to get your take on what Taylor mentioned earlier there, that we are seeing, according to Facebook, flat ad sales for the first 3 weeks of April, but the question is, could it get worse? And the real concern is about Q2, not Q1. What's your overall take?
Yeah, I think those are really excellent points. And I 100% agree. First of all, Q1 was a better quarter than most people expected. I do have to remember to say, though, that January and February were pretty much normal months. So we really only had March as being the month where there was a lot of concern and downturn. So for those who were saying that, Q1 was potentially going to be negative, I don't think we ever thought that in our particular models. But, you're right. Looking at Q2, there's a couple of things that really stood out for me. And I want to push back on the idea that the fact that Facebook has been flat for the early part of April is necessarily a good sign. If you compare that to what Snap reported last week, Snap actually also, which is very unusual for these companies, by the way, Snap gave an estimate that year-over-year revenue in the first couple of weeks of April actually grew 15% through April 19th, whereas Facebook said it was flat in the first 3 weeks. So if you compare those two companies' performance, then you have to wonder, well, what's going on here? It makes me think maybe Facebook's performance is actually worse than people think. And if there's stability in terms of flatness, that's not necessarily as good as having at least some revenue growth year over year in the beginning of the quarter. So that's something I'm going to want to pay attention to. I don't know if we're going to see something.
Yeah. The question then is, how bad does it get? And what's your sense? What's your sense of how bad this could get based on signs you're seeing in other places?
Yeah, and unfortunately, no one has a full crystal ball on that. I mean, I think one of the big issues is that businesses are reopening at vastly different rates around the world. So you have some countries where business is starting to reopen. There are other countries and even regions within those countries, like in the United States, where businesses are very much locked down. So any recovery that's going to happen at Facebook is going to be incredibly slow. It's got to be. With all of this, all these varying opening rates going on, I mean, you don't know what businesses are going to be open, to what extent, in which markets. There's a lot of change and challenge ahead, I believe, for Facebook. And that reflects itself in a lot of different types of businesses. I mean, we haven't talked about Facebook's exposure to small business. Small businesses are hurting horribly around the world. And Facebook has always touted the fact that they have 8 million advertisers, and that's obviously a very large percentage of those are small businesses. But I think a lot of that ad revenue could be in jeopardy because these businesses are trying to stay afloat, let alone actually spending more on marketing. So that's a concern that I think we still haven't seen fully play out, and we'll also be paying a lot of attention to that as well.
Okay, so small businesses, one big concern. What about Instagram? What about WhatsApp? What could the other pain points be?
Yeah, well, Instagram has always been a bright spot, I think, for Facebook, and I think it will continue to be. We think that advertisers are still very intrigued with Instagram, with stories, with shopping-related ads. That's definitely a place where I think advertisers are going to continue to play. Obviously, WhatsApp, I mean, the advertising potential within WhatsApp is pretty much non-existent because Facebook has pulled back on advertising within WhatsApp. And Messenger does have ads, although we don't hear a whole lot of traction on Messenger ads either. I think that, going forward, I mean, if we spin even further forward beyond Q2 and we think about some of the initiatives that Facebook is taking in terms of opening up video messaging and video chat, some of the announcements that they made last week for Messenger Rooms, we could see ad revenue potential in those areas, but that's definitely further down the road. So we're going to have to kind of weather through this difficult Q2 before we start to see any momentum on new or experimental areas of advertising like that.
These results also sent Twitter shares up. I'm curious, how do you think Facebook fares compared to Google, which, obviously we heard from Google yesterday. They're both getting the lion's share of the digital ad dollars, but does Google have an advantage given that, its bread and butter is search that Facebook doesn't?
I think that they're both in similar positions, and I think we saw that in the relative earnings reports between the two companies. I think that Google does have potential risk because it does have a lot of small businesses as well that are part of its advertising roster. But it did say in its earnings yesterday that a lot of the searches that were happening were not necessarily related to commodities, the things that kind of lend themselves to advertising. I'm assuming those searches were probably related to things having to do with COVID and staying at home, and those are less monetizable. In some cases, advertisers don't want to advertise on terms related to that. They've actually closed off those keywords. So I think if you were to compare Facebook and Google, they're both relatively in similar positions, even though their types of advertising market and the types of advertisers that they would typically reach out to may, in some cases, be different.
So, meantime, Mark Zuckerberg, we're getting headlines from earnings continuing. Zuckerberg saying COVID-19 will have a significant impact on the business. So that, Deborah, sort of alluding to what you said there, that there's so much that even Facebook, even Mark Zuckerberg himself, cannot foresee. And how dangerous is that?
Well, I think it's dangerous for every business. I mean, this has been said many, many times before. We're in unprecedented times. I mean, this is the uncertainty around the economy of markets around the world is weighing on every single business around the world. So I'm not surprised that Mark Zuckerberg doesn't know what's ahead. It's certainly something that a business like Facebook is going to have to confront, along with all of the other businesses that advertise on Facebook. I mean, that's really where it's going to come down to, is when these major advertisers, the auto companies, the entertainment companies, the travel firms that typically advertise on places like Facebook and on Google, when they are starting to be able to come back and open business. And there's so much uncertainty about the future for those businesses that I'm really not sure either exactly how they're going to weather this.
Well, if you did, we'd all be coming to you for the answer. Deborah Williamson, as always, thanks so much for sticking with us and giving us your thoughts. Meantime, we do have some breaking news. We're getting some comments from the president and also the governor of Florida saying they're planning to start reopening their economy on Monday, May 4th. The president saying he wants the country reopened and is concerned about being closed too long and that he would intervene if decisions made by the states were unsafe, but he wants to see sports stadiums packed again. We'll certainly be watching to see how other governors and other states respond to what the president's saying. Meantime, coming up, we're going to dig into Microsoft's earnings results, their first of the COVID era. How is all this remote work from home driving activity in the cloud? We'll take a look. This is Bloomberg. Continuing our look now at big tech earnings, Microsoft shares also skyrocketing after hours with all the new activity in the cloud and remote work happening from home. I want to bring in Glenn O'Donnell, an analyst with Forrester Research who covers Microsoft. Glenn, we expected Microsoft results to be good. Morgan Stanley naming Microsoft its top pick in uncertain times. Is there anything surprising about these numbers?
Not really. We expected them to do well, and it has been one of the companies that is still shining through all of this, and not surprisingly because it has been providing a lot of the technology that people need to get through this. All the work from home and teleconferencing and that kind of thing. Microsoft's products have been in high demand.
So where do you expect to see continued growth? And are you at all concerned that as the economy starts to reopen, we're hearing about it happening right now in Florida starting on May 1st, that some of the gains that Microsoft has made, whether it's in their Teams chat product or elsewhere, do those gains start to decline?
I think we will see some usage decline. However, much of what's happening now is going to continue as the new normal. As people start going back to the offices, not everybody goes back to the office. And I think we've all learned how useful these technologies like Microsoft Teams and Zoom and some others have been. And I have to say, I use all of these systems, and I've been personally very happy with Teams. The quality of the voice and video has been very good, and I think that's a testament to how Microsoft has not just designed its technology, but also handled the load. Most of these subscription services, you assume you're going to have X% of your customers using it at any point in time, and suddenly you have 10 or 20 or even 100X that factor, and you may run out of capacity. And that has happened with Microsoft. It's happened with everybody, but I think Microsoft has been weathering the storm well, and that bodes well in the long term because they're building trust with customers.
Meantime, we're getting headlines in now from the Microsoft call. Microsoft saying their Xbox Holiday 2020 launch is on track. Gaming is another huge part of Microsoft's business, and we know that gaming has generally seen a boost as a result of all of us being shut in. How much do you expect the gaming sector to buoy the overall business?
It's overall, it's still a fairly small percentage of Microsoft's revenue, so it's not going to make that big of a difference. And based on the release that they issued today, Xbox content and services were up 2%. I would have expected more, but coming back to subscribers, you pay for the usage, and you use it more. It's basically going to cost you roughly the same. So revenue-wise, it's not going to make a big difference when you have those bursts of activity. But again, the capacity is there, and gaming is a big business, but overall in Microsoft, it's still a fairly small percentage.
Meantime, Microsoft is also saying that the coronavirus and the pandemic is also hurting one-off licensing deals with small businesses. We know that small businesses have been particularly hurt by this crisis. The president is having an event with small business leaders at the White House right now. He's telling them the target date for reopening is as soon as possible, but that can, of course, and will, of course, vary from state to state. As we start to see these moves with these states reopening, what do you think the impact of this is more broadly on the markets and the companies that you cover?
Yeah, small business in particular has been suffering, and I do have concerns about the small business sector. Large business, most of it's okay. Travel and entertainment aside, the rest of the economy is still moving, albeit at a sluggish pace in some places, but the machinery is still trying to operate. So I think large companies are going to weather this. Small businesses is a different story, and the sooner we can get things restarted, the better small business is going to be. And the technologies from Microsoft are going to reflect that, as well as other technologies. If you go out of business, you're not going to be using your Microsoft Azure services anymore. But we'll have to watch that play out and see how small business performs and how things recover once we do start getting back in business here.
All right, Glenn O'Donnell of Forrester Research, thank you so much.
Thank you.
Glenn, we'll have to leave it there. Thank you so much for taking the time. Good to hear where you stand right now. Meantime, some headlines rolling in from the Facebook call. Facebook saying its profit margins will shrink this year due to COVID-19, but Facebook CEO Mark Zuckerberg saying Facebook plans to hire 10,000 more employees this year. That, of course, in contrast to Alphabet saying that they're slowing down hiring through the end of the year. So interesting to see that from Zuckerberg. We're going to continue to listen in to the call and bring you more headlines as we have them. Meantime, coming up, Google wants in on the Zoom action, making its Zoom competitor free. We'll talk to our own Mark Bergen about that coming up. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang. Google Meet is now going to be free for all users. Google wanting in on the Zoom action. I want to bring in our Mark Bergen, who covers Alphabet and Google for us. So, wow, this is a huge move. Obviously, Google Meet has been a video conferencing competitor, an option to Zoom. However, Zoom has really gotten a lot of the mind share. What does this actually mean, Mark?
Yeah, I mean, it means Google has a chance to sort of catch up, right? This is, one way to look at it is Google had Hangouts chat for years, right? They have Gmail, they had this built-in, they have the bandwidth technology and the money. This sort of video chat was theirs to lose, and they lost it in many ways to Zoom. And then we saw Verizon Wireless getting in, Microsoft with Teams getting much more aggressive, and now last week Facebook announcing that it's coming out with its own free video chat service. So I think this is sort of Google's only way to get a foot in here, it's a strong foothold. They are requiring people sign up with a Google account to use this, and clearly right now they said they have 100 million users of Meet. I'm sure that number is going to skyrocket once it becomes free.
And Zoom does have, a free option, but what does this mean for Zoom, for Microsoft, for WebEx, for the other players in this game?
Yeah, so Google's right now saying that they are capping they have a 60-minute limit for this, but they're not enforcing that till September. It'd be interesting to see if this becomes something where it's a lot of people just using it to catch up with friends, or if it's something that a lot of businesses start to use the free version, right? I think Google's logic here is that that they use a free version, they're most likely going to start signing up for the paid G Suite account, and that's where Google's really trying to challenge Microsoft. Zoom stock was down about 11% today. There's some argument whether that stock's been inflated for a while, given their revenue, but it's clearly a challenge for them.
Right. And of course, Google has deep pockets, so can do something like this. Okay. Bloomberg's Mark Bergen. As always, Mark, thank you so much for your insights there. Coming up, we're going to take you back to earnings results and dig into Tesla with its first quarter earnings report as production remains halted at its headquarters here in California. We'll be speaking to Tasha Keeney of ARK Invest coming up. This is Bloomberg. Welcome to Bloomberg Technology. I'm Emily Chang in San Francisco. To Tesla earnings now, profitability better than feared. Tesla saying it's still on track, still can deliver 500,000 vehicles by the end of the year, but production remains a huge concern. Production at its headquarters in Fremont, California, has been ground to a halt. I want to bring in Tasha Keeney of ARK Invest, and Tesla is the firm's top holding in many of your funds. Tasha, what's your take on the headline results here?
Yeah, so I think, a lot of focus is going to be on sort of these short-term, when is the factory going to reopen? Exactly what is the next quarter sort of going to look like? But I think in terms of the long-term picture, which is what we're interested in at ARK, we're long-term investors, the long-term impacts of COVID-19, we think, are going to be that the auto industry, which was already going to consolidate because of autonomous electric vehicles, not every automaker was going to successfully survive that transition. That's just going to be pulled forward. So you're going to have companies that are going to be struggling. They're going to look to the core business. They're going to start cutting innovation projects. We just saw Ford cut their effort with Rivian for electric vehicles. And companies like Tesla that are already further ahead on autonomous electric technology are really going to shine here. I think for the short term, the China factory is really key for Tesla. That's already back up and running since the shutdown earlier this year. So we're looking forward to sort of see what happens.
But what about demand? I mean, it's certainly one thing if they can't make the cars, but let's say production restarts. Is demand really going to be there when you've got 22 million people out of work, unemployment at 20%, and economy that has been plunged into a recession?
Yeah, I think for the auto industry as a whole, we could see auto sales actually hit their peaks. We think that longer term, two-car households are going to become one-car households as we undergo this shift towards autonomous technology. But for something like electric vehicles, and particularly in Tesla's case, they've always been supply constrained. So we really see sort of that demand still there. And in the next couple of years, an electric vehicle on a like-for-like basis, according to our work, is going to be cheaper than a gas-powered car. So that sticker price is really what's going to drive that uptick in demand. So it's already lower on a total cost of ownership basis and on an operating cost basis. Now it's going to become cheaper on a sticker price basis.
I want to ask you also about regulatory credits, because there were $354 million in revenue attributable to regulatory credit. And I wonder if without those, the situation would look very different and significantly worse. I mean, what are your thoughts on that?
Well, I think the key number to look at in the report is automotive gross margin excluding credits, which came in at 20% for the quarter. That's higher than most analysts were expecting. They were seeing something that they thought there would be something in the teens. I was seeing between 16 and 17% for estimates. So that number be excluding those credits, but zooming back out, when we model disruptive technology at ARC, we don't take into account any regulatory action. It's hard to predict, and we want technologies that are viable in the underlying economics without any of those subsidies. So that's how we model electric vehicles and the battery cost declines associated with them. So even without any of the support from these credits, we think EVs will take off just on those economics.
So it's certainly one thing if the car industry in general is slowing down and slowing down, especially after this. And I understand that Tesla might be a winner relative to other car makers, but it can't be good for Tesla if people in general are going to own less cars. People in general are going to be financially strapped. And I wonder how that fits into your long-term optimism here.
Yeah, I think so. Here's what I'll say. The long-term picture, I do think people are going to own less cars, and it's because they're going to start using autonomous ride-hailing networks. And one interesting opportunity that I think is really overlooked for Tesla is they plan on launching an autonomous taxi service once they achieve full autonomy. But even before that, Elon Musk has said that they would launch a ride-hailing service with human drivers. Assume that they did that coming out of the crisis. There's going to be a pent-up demand for gig workers. Uber and Lyft are hurting right now. Tesla is already cheaper on an operating cost basis than a traditional car. That could mean better driver pay, a better take rate for Tesla. They could collect more miles for autopilot, and they have a vertically integrated financing and insurance offering. So we actually think that business in particular could have very good profit characteristics for Tesla. So really, Tesla's transforming into the services model longer term. So I think that's what we really want to focus on. But, again, big picture in the automotive world, everything is shifting towards electric vehicles. And Tesla is the leader in electric vehicles. We think they're 3 years ahead of the competition. So even on the core business, that's sort of the view that we look at.
Another point that you've made in some of your research is that you think that Tesla's plans to start a ride-hailing business, that they should do that sooner rather than later as we come out of this crisis. I find that interesting, especially given that Uber and Lyft are really struggling. Lyft just announced a round of layoffs. Uber is considering reportedly a big round of layoffs. Why do you think Tesla should invest in that right now?
Yeah, so, as I mentioned, Tesla has this innate cost advantage over anyone operating a different car, because electric vehicles on an operating cost basis, we already know are cheaper. Maintenance is cheaper. Total cost of ownership is cheaper. So that's sort of, a better characteristic for drivers to sign up. And then the financing and insurance, because Tesla is able to offer that, and that's vertically integrated into the company itself. We think they could have a better cost profile and profit profile on that business as well, compared to Uber and Lyft that have to look to outside partners. The reason to do it coming out of the crisis is because, so right now, ride hailing is hurting, and that makes sense. But if you think about when the stay-at-home bans are lifted, would you want to get into mass transportation, or are you going to want to get into maybe a ride-hailing vehicle or a personal vehicle? We actually heard today on the NXP call that we're already seeing people buy their first car ever because they want to avoid mass transit. So I think that ride-hailing could actually be strong coming out of this. So that's sort of another reason for Tesla to really strike while the iron's hot. And again, sort of those underlying cost dynamics already set up a really nice profile for Tesla. It aligns with its long-term vision to become an autonomous taxi provider. So I think the time is really now to do that.
Interesting. All right. Well, that's something we'll certainly continue to follow. Tasha Keeney of ARK Invest. Always good to have you with us, Tasha. Thanks so much.
Thanks for having me.
All right, coming up, we're going to dig into those Uber and Lyft layoffs. As I just mentioned, Lyft announcing today it's planning to lay off a huge chunk of workers. Uber also considering some layoffs. We'll have that story after this quick break. Taking a quick look at Facebook shares after hours skyrocketing. Mark Zuckerberg saying Facebook plans to hire as many as 10,000 people this year, 10,000 additional employees. This as Google has announced a hiring slowdown. Facebook saying ad sales were significantly down from travel and autos in particular, particularly relevant to the conversation that we were just having. They see strong ad growth, however, coming from the gaming industry, and they're starting to see the first signs of stability for the ad business in the first 3 weeks of April, with ad sales during the first 3 weeks of April being flat. Facebook will, however, be looking to cut travel, marketing, and construction costs. We're continuing to listen in to the Facebook earnings call, and we'll bring you more headlines as we have them. Meantime, I do want to talk about ride sharing. Lyft announced today it is letting go of 17% of its workforce, furloughing more employees. Uber also reportedly considering some big layoffs as well. I want to bring in Bloomberg's Lizette Chapman, who covers ride sharing for us. Lizette, let's start with Lyft, since this is what we know for sure. Walk us through the cuts and what this means.
Right. So Lyft announced today that they would be slicing 1,000 of their employees, or about 17% company-wide. This would take effect immediately. And they also announced a 5% furlough of employees, along with pay cuts company-wide, ranging from 10% up to 30% for the executives. They also announced that they were going to suspend scooter operations. And this was a series of cuts that they said they had to make.
What do we know about Uber's plans? We know that the chief technology officer is stepping down. He's been there a long time, but also reports that Uber is considering laying off 20% of its workforce. Do we know more?
Correct. There have been reports that they are considering that. The company has not yet formally commented. The longtime CTO did, resign recently, and gave his notice. And this follows Maneet Gupta, who was the CPO, who resigned a couple weeks ago, as well as Jason Dragill, longtime employee. So they're also facing a bit of a leadership kind of suck, if you will.
A leadership vacuum for sure. I mean, talk to us about the soundness of Uber and Lyft. By the way, those reports coming from the information that Uber is considering laying off 20% of its workforce. Talk to us about Uber versus Lyft at this time. Obviously, Uber is a much larger company, which can be good or bad. Uber does also have Uber Eats. Lyft, however, is more focused almost entirely on the United States, though it has been making small steps to expand internationally. Is one more in trouble than the other?
That's a great point, is that Lyft is focused on North America. Uber is focused globally. Lyft has been completely focused on rideshare and recently spinning up some of its delivery options through partnerships. Uber, on the other hand, has all of these other businesses. They've got Uber Eats, like you mentioned, and they have seen an uptick in that, and that's something that we will be probably watching for when they report earnings next week.
All right, Lizette Chapman, who covers ride sharing for us, thanks so much. I should mention that the scooter company Lime also announcing some layoffs today, 190 people. We're going to continue to cover all of these stories as they continue to evolve. Lizette, thank you so much for that update. Meantime, I want to bring you another story. The Trump administration planning to launch Operation Warp Speed, a Manhattan Project-style initiative to drastically cut the time it takes, and it will take, to develop a COVID-19 vaccine. Meantime, Lauren Sauer, an assistant professor of emergency medicine at Johns Hopkins University, says the country still has a long way to go with testing capacity. Take a listen to a conversation with our own Tom Keene from earlier today.
People are probably tired of me harping on testing, but I think it's absolutely the underpinning of everything else that we need to do. So while we're getting better with testing, we still have a long way to go, and we really need to keep laser focus on that. On the medications, we're seeing a lot of progress. We're seeing vaccine progress, which is great to hear because that is going to be a key to long-term fighting of this disease. But again, a lot of ways to go.
What do you find the most reassuring and the most concerning about testing? How much more testing do we need in the U.S., and are the tests reliable right now?
The point-of-care diagnostics are getting better, and they're getting picked up more broadly. We still have major issues with the supply chain around testing, so we still need the reagents, the materials that we need to run the test. We still have issues with the swabs that you use to take a lot of these tests. Still have to focus on making sure that we don't just have enough tests, but they're in the right place, because the key to reopening and the key to getting back to work is making sure that the tests are distributed in a way that we can detect where clusters may pop up and where new outbreaks may occur.
Lauren, let's go to your core competencies, which is emergency medicine. Okay, so we're going to have emergency rooms in May, in August, in October across this nation, where people are going to walk in the door because, afterthoughts stubbed their toe or somebody broke an arm, et cetera, et cetera. We're going to test all those people for the virus, aren't we?
That's the hope, so that we can move them into the hospital and get them the care they need without putting them at risk, putting our other healthcare workers at risk, and putting our other patients at risk. So the idea would be as people who don't show symptoms of COVID-19 come into the hospital, we would put them in a different part of the hospital and still be able to safely care for them while we're caring for COVID-19 and while we're still dealing with having COVID-19 out in the community.
Well, I look, Lauren, at this and, the huge challenges. I'm right here by Mount Sinai on the Upper East Side in New York, and you can just see it in the faces of the people. Are we going to end up with 2 emergency rooms, 2 hospitals?
I hope that we aren't. I think we can't distribute our clinicians like that. We can't distribute our resources like that. I think we hope that this will become a disease that we can manage with tools like we have for other diseases that make people really sick, like flu, like HIV, like a bunch of different diseases, where we can find people who have it early, safely care for them without putting others at risk, and that our supply chain and our resources allow for that.
I look at all that's going on in the virus, and of course the sadness here of 58,000 deaths as well. And we make an historical note, the same amount as we exceed those killed in Vietnam as well. Give us a scope and scale at the Johns Hopkins University right now. Can we say that you look forward to a May that will be improved from April?
I do hope so. I think we're seeing a slowdown in our cases, and we're starting to feel that pressure release a little bit, but that's the time to be vigilant and not let our guard down, because we will see spikes in cases, especially as people relax their social distancing practices, as they try to go back to work, as they, just get tired of being at home and make different choices. So we have to remember that just because we're seeing that slowdown in cases doesn't mean this is over, and doesn't mean that we suddenly have a toolkit full of tools to fight this. So we have to be protective. We have to follow those social distancing still, and it does get hard. And I think we have to remind each other that it's still really important.
All right, coming up, we're going to be talking about Amazon. Amazon also reporting earnings later this week. We'll get a preview from our own Matt Day. Coming up, this is Bloomberg. Amazon set to report its first quarter results tomorrow. I want to bring in Bloomberg's Matt Day, who covers Amazon for us. Obviously, so many issues to discuss with Amazon. They halted their non-essential e-commerce business, but obviously saw a huge spike in essential items. Grocery delivery was a huge part of this quarter, but still a relatively small part of Amazon's business. What are you going to be watching, Matt?
So I think the Amazon's sort of mix of sales is going to be super interesting. Traditionally they haven't been a company that's relied a bunch on groceries and staples. Obviously that's switched like a flipping a switch, as the pandemic came and people shopped from home. So some analysts have flagged that as potentially a lower margin business, but I think it's, overall it's going to be kind of what they've been selling and how much demand boost they saw from people sheltering at home.
What about advertising? Advertising has been a growing part of Amazon's business, and they've been coming in a distant third to Facebook and Google, but supposedly, an increasingly important part of the business. And now that we've seen Google and Facebook's ad businesses suffering, especially at the end of March, will we see the same for Amazon as well?
I think so, and analysts certainly seem to think that. Advertising is free money for Amazon once they turned on this business largely. Just paying to be at the top of search results on Amazon.com is a very lucrative business for them, much better margins than their retail business. And I think people are expecting that to take a hit, not only from the economic slowdown, but people who sell on Amazon, if you buy an ad and it points you to your listing, and if you have nothing to sell because you're out of inventory, you're going to get pushed way down their rankings. A lot of people have been pulling sort of proactively their spending on Amazon to avoid that.
How about AWS? Could that be the bright spot? Or with companies suffering as a result of the economic crisis, are they not going to be able to pay up for that?
I think Microsoft's results today offer a good clue. They're running a second to Amazon in the cloud computing business, and and in the long term, this only makes a better case for sort of on-demand computing power. But in the short term, we might see some sort of mid-sized businesses pull back just because they don't have maybe the cash right now to do that cloud computing shift they might have had planned. Now that they got bigger issues like making payroll.
Meantime, Amazon just got an exclusive deal with the NFL to stream its live games. This, of course, on top of Twitch, which Amazon owns. How much could this help?
Amazon's really desperate for live sports content. They've been making a push for English soccer. They got other deals with leagues around the world. And this is, them trying to take that next step in making Prime Video, which has some pretty well-liked original content, to make that sort of a sports destination as well. And see how they can break into new areas of entertainment for their Prime Video business.
And what about Prime Video? Obviously, we know that Netflix saw some, pretty incredible numbers, but they're also looking at content drying up, especially in the second half of the year, if they can't restart production on some of these shows. I assume that Amazon would be in a slightly worse position than Netflix. What do you see?
We haven't heard a whole lot of chirps from them, but I think we expect similar dynamics to play out there. They've clearly, Amazon Prime has decided they're in an arms race with Netflix for content. So they were shelling out billions of dollars a year on new series. That stuff is paused. The build out of the California outpost they've expanded to is paused. So I think they might face some of the same struggles as Netflix.
All right, Matt Day for Bloomberg News. We'll be covering Amazon tomorrow, of course. Thank you so much, Matt, for your insights. And just to recap the big earnings we've been reporting on throughout the hour, Tesla, Facebook, and Microsoft all reporting strong numbers, all seeing their shares rocket after hours. Tesla posting a surprise profit for the first quarter that the company burned through almost $900 million in cash. Tesla still saying they can deliver 500,000 cars before the end of the year, but the question will be production. Facebook reporting revenue and users that beat estimates, and also saying it sees signs of advertising demand stabilizing in the first 3 weeks of April. Ad sales basically flat. We're going to dig into this a little bit more after the show, and also be across Apple with results out tomorrow. Apple and Amazon tomorrow. You won't want to miss that right here on Bloomberg Technology. Bloomberg Daybreak Australia starts now. This is Bloomberg.